Welcome to 5 Minutes, your quick dive into the wide-ranging world of insurance, technology, and leadership. I'm Miguel Edwards, and I'll be your guide as we explore these topics that are transforming not just the insurance industry, but the business world at large. Along with sharing observations I've made over the span of my career in insurance, technology, and operations, I'll be chatting with some of the brightest minds in business and leadership. Whether you're a seasoned executive or a rising star, an industry expert, or just curious about how technology is revolutionizing insurance, this is your perfect spot for your weekly dose of insights. This is 5 Minutes. One of the things that comes to mind, particularly as I think about the incredible growth that you just cited with DUAs, when you think about that, what are some of the risk management practices that carriers need to be thinking about, they need to be mindful about as you think about this growth and just kind of handing over that pen? What are some of the things that carriers need to be thinking about to effectively managing the risk that's associated with this growth?
They need to have due diligence, again, due diligence. They need to have an analytical approach to their partnerships and how they're going to establish a long-term partnership with delegated underwriting authorities. So vetting these partnerships helps carriers not only verify the program's profitability, but it should vet the stability of that profitability. And so they need to determine whether the program's objectives, their financial health, their operational history with compliance, with risk appetite, and their reputation. You want to make sure that that's a good match for carriers. And so with that being said, due diligence really is an underlying risk as the sector becomes more enriched with capacity investment. So the more capacity, the more due diligence.
Got it. That makes sense. You were kind enough to send me a deck ahead of our discussion that kind of explains some of AM Best's process for evaluating DUAs. Is that report and those ratings, is that another mechanism that carriers can use as they're evaluating these entities as far as how well you show up? Because I know particularly as you think about when I was on the broker side of things, we use the AM Best rating as on the carrier side as in terms for market security. These are the carriers that we were willing to leverage. Is that an appropriate use for carriers thinking about using that rating accordingly? Absolutely.
And so, just to be careful from the rate, to kind of like draw the distinction between rating and assessment. It's right. So it is an assessment, not a rating. And yes, to answer your question, your overall question, you're right on the money. This is definitely a tool that carriers can use in their process, in their due diligence process already, that they're already undertaking, that they want to look at maybe a deeper look at their financial strength, when they want to look at some of their underwriting practices, some of their policies and procedures. What are their geographical locations? What's the depth and breadth of the relationships that they have? So this report is going to highlight how these delegated underwriting authorities are differentiating themselves in the market and what are the outcomes, and have they been consistent, and are they stable?
No, that makes good sense. It was fascinating reading, just like thinking about all of the different dynamics that go into that. Shifting gears on you here a little bit, Dawn. There's lots of reporting out there about how much private equity money is flowing into the insurance industry. We're seeing it. In fact, there was a point where I think regulators had to be careful and pump the brakes on how much private equity was going on the carrier side of things, because that was creating some market dynamics. But when you start thinking about kind of the lower regulatory bar that exists for DUAs, we're starting to see private equity money is now flowing into those types of entities. I think I saw a report somewhere, it may have been in the AM Best report, that talked about the fact that it's attractive to PEs because the capital surplus requirements that you would have on the carrier side don't exist there necessarily for the MGAs. And so therefore, you get a higher return on capital. But as you start thinking about all that PE money coming in, what are some of the regulatory concerns that you think are essential that we have to ensure that these investments don't compromise the financial stability for insurers and in the broader market?
Right. So thinking about regulatory oversight practices that, they're essential to the goal of, financial stability of insurers in terms of that private equity investment. And, it benefits to have an enhanced disclosure.
Okay.
Disclosure is kind of like the key. I think it's the missing thing.
Thank you for joining this episode of 5 Minutes. If you've enjoyed our discussion, we'd love for you to share it with anyone else you think might find it interesting. Also, please subscribe on whatever podcast platform you're listening on and hit that bell to stay on top of the game with our practical 5-minute episodes. We look forward to seeing you again next week.